Let's jump right in. For the past couple of years, Wall Street's obsession with artificial intelligence has basically boiled down to three simple words: buy the future. We've watched billions of dollars flow into AI, treating it like this totally unstoppable, invincible force. But in this explainer, we're going to look at how that massive hype train is suddenly showing some very real, undeniable cracks. Case in point, we are getting a sudden reality check. Look at what happened on August 18th. Micron dropped 7%, Broadcom lost over 3%. Even NVIDIA, literally the undisputed heavyweight champion of this space, fell by more than 2% in a single day. And look, these aren't just your run-of-the-mill daily market blips. When supposedly invincible AI darlings suddenly stumble like this, it signals a massive shift in investor psychology. The market is finally waking up from pure euphoria. And this isn't just retail investors getting a little jumpy. Economists affiliated with the European Central Bank have outright said, quote, "A correction in U.S. technology stocks driven by excessive optimism around AI is likely." Now, let's be absolutely clear. This is not about AI being fake or some elaborate scam. The tech is incredibly real, but this is a really uncomfortable warning from top-tier institutions that investors might have just priced in way too much of the future way too fast.
Part 1. The infrastructure math problem.
So, where are the profits? It's kind of the most fundamental question you can ask in business, right? We've spent 2 years completely mesmerized by what this technology can actually do, but now the spotlight is aggressively shifting away from the tech's capabilities and pointing right at its financial viability. Everyone is spending money, but who is actually making it?
Because honestly, building the future is astonishingly expensive. We are talking about multi-billion-dollar data centers built totally from scratch. We've got rapid chip obsolescence, which is wild because we're not building steel bridges meant to last 50 years. This cutting-edge hardware gets outdated incredibly fast. Throw in the massive electricity demands, wildly expensive cooling systems, specialized networking. You get the picture. Big tech is throwing extraordinary amounts of money at this infrastructure. But all those massive upfront costs, they don't automatically guarantee immediate cash flow. And eventually, someone is going to have to foot the bill.
Part 2. Wall Street's $500 billion bet.
Okay, the crucial takeaway here is this absolutely staggering number: $500 billion. $500 billion. NVIDIA recently announced partnerships with massive financial heavyweights, think Blackstone, BlackRock, Goldman Sachs, specifically to mobilize this gigantic pool of third-party capital just for AI infrastructure projects. The industry doesn't just need silicon anymore. It needs literal mountains of institutional cash to build the physical warehouses where these chips actually live.
And honestly, this brilliantly illustrates the terrifying catch to this whole financial setup. On one hand, you are taking on long-term debt, financing structures designed to be paid off over 10 to 20 years. But on the exact opposite side, you're funding short life cycle tech. AI computing equipment evolves and upgrades at breakneck speed. You are literally funding rapidly changing short-lived technology with decades-long debt. It's a massive, glaring structural mismatch.
And hey, this isn't just some theoretical doomsday scenario cooked up by skeptics. The Bank of England is actively sounding the alarm, stating that increasing debt financing for AI infrastructure could become a genuine financial stability risk if these companies struggle to generate returns. Basically, major global authorities are asking the trillion-dollar question: what actually happens if this massive infrastructure gets built way faster than the paying demand for it? It is a recipe for some serious economic heartburn.
Let's move to Part 3. Echoes of the dot-com bubble.
It is impossible not to compare the late 1990s internet boom with 2020's AI. On one hand, you've got the technology. The internet genuinely transformed the global economy, and AI is very likely going to do the exact same thing. But on the other hand, you have the valuations. Back in the 90s, expectations completely detached from reality, which triggered a huge market collapse, even though the underlying tech was totally real. So keep this in mind. It is entirely possible for a technology to be completely revolutionary while its stock market prices are simultaneously caught in a really dangerous bubble. Both of those truths can exist at the exact same time.
Part 4. The expectation trap. Wall Street's whole logic right now relies on a very specific interconnected chain of expectations. Investors are banking on massive productivity gains across basically every industry, which then leads to exploding cloud demand, which justifies sustained data center growth, which ultimately results in infinite profits for NVIDIA. But here's why this matters so much to us. This chain is incredibly fragile. Because it's all linked together, if even one single step in that sequence disappoints, the entire rest of the market ecosystem is gonna feel the shockwave. Because,
Markets fall not necessarily from a disaster, but just from disappointment. Think about it like this. If a company is expected to grow its earnings by 50%, but it only grows by 35%, well, in the real world, a 35% growth rate is a wildly successful business. But to the investor who already paid top dollar expecting 50%, it feels like a total failure. They panic, they sell, and that is exactly how bubbles start to violently crack.
So if these sky-high, totally perfect expectations fail to materialize, we really have to ask the hard question: who actually gets hurt? What is the blast radius if this AI boom turns into a serious market correction?
Well, the contagion risk is honestly much broader than you might think. Obviously, it starts with direct AI investors taking immediate stock market losses. But then, it trickles down to the infrastructure borrowers, who suddenly can't service that massive long-term debt we talked about earlier. And crucially, think about global index funds. Tech concentration in those funds is so heavy right now that an AI crash would severely drag down the entire broader market. This correction would absolutely not stay safely contained in Silicon Valley. It would aggressively spill out into the global economy.
Just to put into perspective how global this really is, consider this number: 440 billion euros. That's the European Central Bank's calculation of euro area households' exposure to U.S. tech equities, mostly through their everyday mutual funds and pensions. A crack in the U.S. AI boom immediately hits the retirement accounts of folks sitting in Paris, Berlin, and Rome. It is all deeply connected.
Finally, part 5. Boom or bubble?
Before we wrap up, we have to remember one vital fact here. Microsoft, Amazon, NVIDIA. These are highly profitable companies with massive, real cash flows. They're not empty concepts. Unlike some of those profitless.com companies from the late 90s that were essentially just a catchy website and a dream, today's AI leaders have genuine, huge operations and generate billions in actual revenue. The technology is very real, and the business foundation is solid.
Which leaves us with this final, provocative thought: AI growth versus investor expectations. Are we looking at our generation's greatest boom or its biggest bubble? Because the biggest story over the next few years might not actually be about who builds the absolute smartest AI model. It might just be about who can actually make the math work to sustain it. I hope this explainer helped you grasp the massive economic forces at play here behind the technology. Thanks so much for joining me, and I'll let you chew on that final question. Until next time.